Okay, folks. Reminder, though you don't need one, I think that your project is due a week from today.
We're almost done.
Good. The thing is, each week, the gap between where I am and where you are should have narrowed. So by now, you should be pretty close to where I am. Okay. So we're in the last stretch here. We're going to talk about dividends and valuation this week, kind of put the crowning point on this class. And let's review where we were in dividends. We looked at how much a company can afford to pay in dividends. Not rocket science, right? From the statement of cash flows, you come up with a free cash flow equity. And be open to the possibility that that free cash flow equity can be negative. Okay. And then you look at the cash actually returned, which is also on the statement of cash flow. So it's almost everything you need is on the statement of cash flows in the form of dividends and buybacks. So what I did last year when I was doing my data analysis for all publicly traded companies, I computed the free cash flow equity for every company, and I computed the dividends and buybacks for every company. I just want to get a sense of what do companies do. So this is a summary across all global companies, 47,000 companies. Let me start at the top. You look at, and I've broken it down by region. Let me focus on the grand total, but you can look at differences across regions. 19%, roughly 19% of companies return no cash, no dividends, no buybacks, and a negative free cash flow equity. Make sense? The negative free cash flow equity, they're doing the right thing. About 8% of companies return cash, which was less than no cash returned. No. So basically, they have negative free cash flow equity, they return no cash, no dividends, no buybacks. No. Second group of companies had positive free cash flow equity, return cash, but return less cash than the free cash flow equity. So if you take those first two lines, these two groups of companies are accumulating cash. Because remember, when you have $100 in free cash flow equity, and you either pay no dividends or you pay less than 100 in dividends, that difference goes into your cash balance. So let's call them cash accumulators. 27% of companies were cash accumulators. Let's move to below the line. There are companies which have no cash returned, but have... Did I go? I'm sorry, that should have been positive free cash flow. This is negative free cash flow equity. These are companies that essentially are returning no cash, but that's all they can do. They can't dig deeper. They actually have to issue stock. There are companies that return cash and had negative free cash flow equity. We'll talk about why some companies get into that trap and how you untrap yourself, because now you're in a bind, right? You're returning cash to your shareholders as dividends, you have negative free cash flow equity. One part of you saying, stop doing these, the other part is terrified of what will happen to us if we cut dividends. And the last group of companies are companies that return cash that exceeded their free cash flow equity. So these three groups of companies are actually burning through cash. And in 2022, at least 73% of global companies were actually burning through cash, returning more cash than they did, 27%. I'm not reading too much into it because year by year, these numbers tend to jump. But for your company, you can make this judgment of what is its free cash flow equity, what can it return? So what I'd like to do is talk a little bit about what happens when companies do accumulate cash. Because when you consistently pay out less than your free cash flow equity, your cash balance builds up. You saw that with Microsoft in 1996, huge cash balance. You see it with Apple today, huge cash balance. But this is a very different case. And to show you how investors treat different companies differently, this was Chrysler in 1994. Now, for those of you who don't remember, Chrysler in 1980 almost went bankrupt. It went bankrupt. It was a bailout, tiny by today's standards, one of the first US government bailouts of a publicly traded company. Chrysler came back with a new CEO called Lee Iacocca. And in 1984 or 85, Lee Iacocca invented a vehicle that we still curse him for, which is the minivan. The Dodge Caravan saved Chrysler as a company. It saved Chrysler, it brought the company back. This is my look at the cash flows. It's what's happening as Chrysler's recovering. So each year what I've done is I've computed the free cash flow equity. That's a white column. Notice it's much more volatile than what you see in dividends because it's a number that jumps around. The black column is the cash return to shareholders, either as dividends or buybacks. Every time the white column is higher than the black column, that's cash accumulating. I've kept track of the cash accumulating the company. In 1985, Chrysler had close to a zero cash balance. By the time you get to 1994, Chrysler has an $8.5 billion cash balance. Right? So that doesn't sound like much, right? Apple has a $200 billion cash balance. But remember, it's all relative. That $8.5 billion cash balance at Chrysler was more than 30% of the company's overall value at that point in time. So Chrysler was 70% automobile company, 30% cash. Yes? You had a recession. When you have a recession, you burn through cash, and they did burn through cash that year. They burned through about $500 million. So in 1994, Chrysler has $8.5 billion, 30% of the company's cash. It got targeted by an activist investor who said, you have too much cash. You got to return the cash. What do you think Chrysler's first defense was? We almost went bankrupt. We're a cyclical company. We need the cash. But embedded in this graph is a pretty severe recession. 1990 was a pretty severe recession. They did burn through cash, but they burned through $500 million in cash. So let me set up a math problem. If the last recession lasted 2 years and you burned through $500 million in cash, how long will the next recession have to last for you to need $8.5 billion in cash? The answer is really, really, really long. In other words, you're preparing for the Great Depression. That argument did not go well with investors. They said, that's too much cash. 2 billion, we can understand, 8.5 billion. So then Chrysler came back with a second argument, and this terrified investors. You know what Chrysler said? We might need to do a big acquisition. Now, the history of acquisitions is everybody gains except for the shareholders of the acquiring company. So Chrysler shareholders were not impressed by that either. Long story short, this fight ended with Chrysler returning a big chunk of that cash to its investors. It then got bought by Daimler in one of the most ill-fated mergers of all time. And the rest, as they say, is automobile history. What I'm trying to say is not all companies get treated the same way when they accumulate cash. Some companies are left alone. Some companies are, you see investors aggressively pushing. So today I'm going to bring up the word that I think drives how investors react to dividend policy, which is trust. Because when you leave cash in the hands of the company, who controls the cash? The managers of the company, right? If you trust the managers of the company, you're much more likely to let cash build up in a company. Whereas if you don't, you're going to say, give me my cash. It's not because you're greedy or selfish. You just don't trust them with your cash. So what determines trust? Will you listen to a man? Say, if I as a man say, come on, trust me. Is that enough? No, probably not, right? You're going to look at my history. And if I have a history of not delivering for you, of doing bad acquisitions, you're not going to trust me. So what I'm going to do is set up a framework for thinking about what to do when you have a company where the cash return is different from the free cash or equity, which is going to be pretty much every company in this class, because almost no company that you look at will have cash return that exactly is equal to the free cash or equity. So here's the framework that I'm going to set up. So let's say you've done this section for your company. Okay? You've got the cash return, you've got the free cash or equity, compare them. One or two possibilities, right? You either have a company that pays too little in cash, it's accumulating cash, like Chrysler was in 1997 or Microsoft in 96, or you have a company that's returning too much in cash. Let's take the too little in cash. If you have too little in cash being returned, you have a cash balance building up, and it's going to get bigger over time. So the question I'm going to ask you is, do you trust the managers in this company with your cash? There are two things you're going to look at, right? One is the history of how well your stock has done. For better or worse, if you have a stock that's been going up 30% a year for the last 10 years, you're far more likely to trust the management of the company because they've been good custodians, at least in the marketplace. The second is, if you don't trust the market, you look at the accounting numbers. Have they taken projects that earn more than the cost of capital? So the Jensen's alpha that you computed in section 2 and the return on capital versus cost of capital you did in section 5 both come into play. And if you look at those numbers and say this company has a history of picking good projects and not wasting my money, you can let cash balances accumulate in companies and nobody's going to push back. In 1997, I went through and I looked through, at that time you had to look through the Dow Jones Newswires. There wasn't one investor was complaining about the fact that Microsoft had the largest cash balance in history. You know why? What did they have to complain about? Stock went public in 86. By 96, one of the great companies in the world already had delivered great returns to shareholders, great returns on projects. People trusted Microsoft in 97. But trust is fragile, right? All you need is a couple of actions on the part of management and you very quickly can lose trust. But in 97, Microsoft was trusted. They were allowed to accumulate a cash balance. 5 years ago, Facebook was trusted. Google was trusted by investors to build up cash balances. We can ask, do you trust Mark Zuckerberg with your cash balance now, especially with the metaverse plans? And you can see how quickly things can change. If you don't trust the management because they have a history of picking bad projects or delivering bad returns for you as a shareholder, then I think you're on completely legitimate ground saying, give me the cash back. If you own 1,000 shares and you get up and say, give me the cash back, what's the reaction of the management? Let's go away, right? But if you can get an ally in this fight, and this is where the activist investing base helps you, right? It's you're not big enough to make this noise, but if a Carl Icahn makes this noise, you can back it. In a sense, you're free riding. Those are the companies which get targeted to give cash back to their shareholders is because people don't trust. So the next time you're a company complaining about the fact that it's being targeted to return cash, before you feel sorry for the company's management, take a look at their track record. There's usually a good reason why this company's been targeted. So that's if you're returning too little in cash. What if you're returning too much in cash? Again, I'm going to look at your past projects. What you think? Why am I looking at past projects? Because I want to get a sense of, are you a company with great projects that's returning too much in cash, or are you a company with bad projects returning too much in cash? Do you see why there's a difference? If you're a company that has very good projects and you're returning too much in cash, you're doing double damage to yourself. On the first hand, you are returning too much in cash. That's a problem. On the other, you're also rejecting probably some of those good projects because you feel this need to continue to pay dividends you can't afford to pay. You actually reduce your value in two dimensions. The facile advice to the company is just cut your dividends, don't pay it. We'll talk about ways in which you can package this dividend cut so it doesn't, remember on the day that you cut dividends, the stock price drops. You want to separate yourself from companies that are cutting dividends for other bad reasons, like our operations are falling apart. But easier said than done. You want to reduce cash pay. And here's the advantage. If you've been buying back stock instead of paying dividends, it becomes much easier. Just stop buying back stock. If you're a company that has bad projects, I don't even know where to start. I can tell you to cut dividends, but you know what I'm afraid you'll do? You'll take the cash and take more bad projects. Here, the source problem is an investment problem. If you don't fix that, changing your dividend policy is not going to fix the problem. You got to fix the investment problem and the dividend problem together. Otherwise, what you're going to end up with is, in a sense, a worst of both worlds. You're going to less in dividends, more cash going into bad projects. You could actually end up being worse off as a shareholder. So put your company into this matrix. Okay? Yes, go ahead.
So when we compare the projects we use return on equity or capital, don't we have an issue when we're using book value of equity there? Capital?
You always should use book value. The problem is not in using book value, because what are you trying to measure with return on invested capital? So let's say you take a project for $100 million 3 years ago. Let's say the book value stays around 100 million. I'm looking at returns based on the book value, but that's what you actually invested in the project, right? So when we do return on capital, the reason we stay with book value is because that's what you actually invested in projects. You know, if you mark to market every project, you know what your return on capital in every project should be? What's the definition of marking to market? That you earn your cost of capital. If we mark to market every project, every company will earn its cost of capital. This is one of my problems with fair value accounting, is you will end up undercutting one of the numbers that we need most from an accounting statement. What did you actually invest in the projects? That said, though, there are other issues with book value, right? If you can play cosmetic games with book, so that is your issue with book value, then I think you have a legitimate point. And that's why when you assess return on capital versus cost of capital, I allow you to bring in those issues to say, hey, the return on capital looks much higher than the cost of capital, but I don't believe that number because they took a restructuring charge or they took a big accounting charge to make themselves look better. So you still have that judgment call, and you're going to carry it into this part of the analysis. So if you're looking at your company, then it's going to fall somewhere in this matrix. On one side, I'm looking at how much cash you returned relative to free cash flow equity, either returning more or less. On the other side, I look at whether you have good projects or bad projects. If you're a company which has good projects and you're returning less than you can afford to, you're going to get maximum flexibility in terms of dividend policy. Why? Because investors trust you. Okay. If you're a company that has poor projects and you're building up cash, you're exactly the kind of company that's going to get targeted by activist investors. So in this box. If you're a company which is paying out too much in dividends and you're a bad project, you don't even know where to start because you have an investment problem and a dividend problem. And finally, if you're a company with good projects and you're paying out too much, you're doing double damage to yourself. So one thing you might consider doing is draw this matrix and plot your companies on. For all you know, all of them can be clustered in one box. It's not unusual in a sector to see every company accumulating cash or paying out too much in cash. But that's a good place to think about comparisons across companies. Now, I told you about Microsoft in '97 being fully trusted, largest cash balance at that time in history. 7 years later, Microsoft paid the largest dividend at that point in time in history. It was a dividend of about, I think they paid a dividend of $33 billion. It was right after, remember I talked about tax laws changing in 2003 and dividends were taxed at the same rate. Right after that passed, Microsoft paid this huge special dividend. They did it because they were coming under pressure because they had too much cash. So you're saying, what changed between '96 and 2004? Anybody remember what happened in 2002 and 2003 to Microsoft? It was actually targeted by the Justice Department as a monopoly. It was targeted because they had Office and Windows. There was talk of making them split up into an office, into a company. At that time, Microsoft was the Darth Vader of technology. Remember, there wasn't a competitor anywhere on the horizon. The Justice Department was worried that Microsoft would take over the world. They got targeted by the Justice Department, and they were in the news for all the wrong reasons. You can see how trust starts to fray. Is issues like that can start to eat away at the trust. You saw this with Facebook. I've never seen a company go so quickly from being a hero to a zero as Facebook went from between 2017 and 2021. The last earnings report, Mark Zuckerberg essentially was one of the most horrific reports in terms of trust. Because here's what Microsoft was saying, or Facebook was saying, we're going to invest, $100 billion in the metaverse. And the market was acting that the entire $100 billion was going to get thrown into the ground and nothing was going to come out of it. That's what trust does. So when you look at your company, make that assessment of, do I trust? Don't make it about everybody. By this point, you know enough about your company where I say, would I trust the managers of this company with my cash? Make it personal. And the answer is no. I think it's perfectly reasonable to say, we want some of that cash back as investors, either as dividends or as buybacks. You have a choice. So what I'd like to do is take my companies through a hypothetical annual meeting, and I want you to play the role of shareholders in this company, and I want you to make a judgment on whether you trust me. I'm going to play the role of a CEO. So let's start with Disney in 2003. Who is CEO of Disney? Michael Eisner, right? So you have a history with me, right? What's your history with me? That I've treated you like dirt for a decade, and I've done things, and I have a big ego, and I do things, and I said, trust me. Remember 6 years ago, I came up and said, trust me, I know what I'm doing, and I bought ABC, and it's paid off badly. So if you look at 2003, as a CEO, here's what I'm coming in with. I'm coming in with a return on equity that's been about 2% less than the cost of equity over the previous decade. I'm coming in with a stock that has underperformed my peer group. And I'm coming in with a plea that I want you to trust me with your cash, because I've also been building up a cash balance over this period of $3.5 billion. So I've built up a cash balance. I come in front of you with a history that is not a great history and say, trust me. What's your answer going to be? I wouldn't trust myself, right? I mean, this is a company where you can see how when CEOs in good times treat shareholders badly, how this comes back to bite them in the bad times. So when you have imperious CEOs who said, these are good times, how dare you question me? There will be bad times. In this case, Eisner's history essentially was getting in his way of, hey, trust me. So 2003, Disney lost this battle. 2 years later, so in this case, you can see that the fact that Eisner's the CEO, you have a history with him, plays a role in whether you trust management. You can also see that the performance of the company is also affected whether you trust the company. It doesn't have to be 10 years. It could be just the last 2 years. In Facebook, it was just 2 years of bad performance. So when you look at a company, this ties back to your corporate governance section. We say, how much power do I have in the company? The answer was, I don't have much power. The CEOs essentially run wild here with a board of directors that's a rubber stamp. And you get to this stage, you say, I don't trust this management with my cash. 2005, of course, Iger got pushed out of Disney. I'm sorry, Eisner got pushed out of Disney and Bob Iger became the CEO. And remember I said for the first few years, Iger was the anti-Eisner. He essentially was, he brought in shareholder input, he changed the board of directors. So let's say so in 2003, Disney had zero chance of winning. They were forced to give cash back because they had no choice. But in 2008, I'm now the new CEO. You're still shareholders in the company, but things have changed. My returns on my projects now exceed my cost of capital. I'm earning more than my cost of capital. My stock has done much better than my peer group. My corporate governance scores reflect the fact that my board of directors is now more independent. And I now have gone back. So during that intervening period between 2004 and 2008, Disney actually returned more cash than they had available because they were, in a sense, pushed into doing it. But as Iger, I want to retain more of that cash. So I come back to you and say, look, we've been giving you back more cash than we have available, but things have changed. We have new plans now. We want to build new theme parks, buy new movie studios. Remember, this was before they bought Marvel and Lucasfilm. So that was still coming. I need the cash. Trust me with the cash. Same company, 4 years later, but a different CEO and a different track record. You can see how trust can shift. In this case, when the vote was put to the shareholders, they were much more willing. It's not guaranteed, but you can see why when management changes and performance changes, companies can start to regain trust. When you start to regain trust, you can start to then regain more power over your dividend policy. So when companies say, look, we feel we are being forced to pay dividends, we'd like to accumulate more cash. There's no quick path to get there. You've got to build up trust. And the way you build up trust is by delivering in terms of projects and in terms of stock returns for your shareholders. And over time, you will gain the trust of shareholders so you can start accumulating cash again. You go forward to Disney in 2013, Iger was starting to lose the faith of shareholders again. And you can see the 2-year Chapek regime at Disney. Disney shareholders essentially lost all faith in management. Now that Iger is back, the question is, how long does he get before shareholders start to get impatient again? Because at this stage, the company's on a fairly short leash, especially with Disney Plus eating up so much in cash flows. Anytime a company does a big acquisition or a big investment, it's putting all its chips on the table and saying, trust us. And you're going to trust them if they have a good history. But if that doesn't get delivered, you're in serious trouble. So Facebook is making a really big bet in the metaverse. It better pay off. Microsoft is making a really big bet on AI. It better pay off, because if it doesn't pay off, the way it's going to show up is you're going to end up with a decade where you have very little power over dividend policy because shareholders no longer trust you. Any questions? So let's talk about Vale. So this is Vale in 2013. Their free cash flows to equity were negative. Why? Because they had all these different debt payments to make. But essentially, they were already underwater with the, before debt payments, after this, so they're already underwater. So we know that a company with negative free cash flows to equity should not pay dividends. and they were paying immense amounts of dividends. And I'll tell you, this is not just Vale. A lot of big Brazilian companies had gotten trapped in this process of paying big dividends. And you're going to see why, while their free cash flows equity were negative. So as a Vale CEO, I'm in trouble. Right? I'm paying out dividends I can't afford to. So you're going to play the role of Vale shareholders. You can see the trouble I'm in, right? I have negative free cash flow equity. I'm paying out big dividends. I ask for your permission to cut dividends. Sounds like a reasonable request, right? But there's a catch here that we talked about very early in this class. Remember I said Vale has two classes of shares, voting shares that are held, a small subset of voting shares that are held by like 7 entities that control the company. All of you at the shareholders meeting own the preferred shares, which get no voting rights. But in return for giving you no voting rights, I also gave you this promise of I'll pay out a fixed dividend every year. In other words, in return for giving up voting rights, you got those special dividends. So what do I want to do? I want to cut those dividends because I can't afford them. Would you demand something in return? I would hope so. In return for no dividends, you'd like to get some voting rights back, right? This is the trap you get into if control becomes the key driver of every decision. So when you ask for voting rights, you know what I'm going to say? No, I'm not giving you the voting rights. I'll keep paying the dividends. This is how you dig yourself into a really deep hole if control becomes the key driver of everything. In fact, if you get a chance, read my post on Petrobras. It's actually, I think, the most negative post I've ever written about a company. Because essentially I said, if you took a corporate finance book and you misread that objective, the objective in corporate finance is to maximize the value of the business, and you misread it as minimize the value of the business, and you ran your company based on that objective, you'd have Petrobras. Because it took investments that earned returns well below the cost of capital. It almost seemed intended doing this. It funded itself with as much debt as it could, even though it couldn't afford it. And it paid out massive amounts of dividends. And it kept repeating and relaundering this process year after year. And it drove its market cap from 200 billion down to 30 billion. It's really tough to do. But one of the elements there, again, is these dividend policies that companies can't afford, but they don't want to give up on them, because to give up on them, they have to then share control with shareholders. So the question is, do you want control, or do you want a company that actually survives? And the answer that many managers unfortunately give is, well, I'd take the control. I'd rather control a company into bankruptcy than run it as a healthy company. So when you look at your company, it is a dysfunctional dividend policy connected back to your corporate governance. Maybe the roots for the dysfunctional dividends come from that. Incidentally, there are countries which have talked about mandating dividend payouts, actually requiring every company that makes money to pay a percentage of those earnings as dividends. I think it was talked about during a French election, presidential election, like 6 years ago as a requirement. He's saying, why would governments mandate dividend policy? Because it increases the amount you get in taxes when people pay dividends. Strange rationale. But let's assume you're in an economy or a market where the government mandates a dividend policy. Every money-making company is required to pay out 30% of its earnings as dividends. Let's talk about what kinds of companies in that market will be most hurt by a mandated dividend policy. I'll go through group by group, and you tell me whether this group will be hurt by a mandated dividend policy. Large, mature companies making huge profits. Why not?
They could use the money on projects, but I mean, if it's huge profits, then they could do it.
Well, if you're large, mature, your free cash flow equity is going to be large positive numbers. You can afford the dividends, and you're going to be fine with the 30% dividend. And if you pay out too much, remember, you have access to capital markets, so you don't feel as affected. Small companies losing money, they're unaffected. Actually, if you lose money, then you don't have to pay. But small companies or high growth companies that are making money, you can see how you put them in a trap. They're making money in terms of net income, but their free cash flow is negative. So what do? You force them to pay out 30% of their net income. It makes it more difficult for them to grow. Do you see why mandated dividend payouts are actually supported by large mature companies? They actually like it when governments mandate big dividend payouts. Because who is it handicapping? The young companies that might be disrupting their businesses. It is terrible public policy to mandate that all companies pay out a certain percent of earnings as dividends. It's just as terrible, though, for public policy to mandate that companies reinvest a certain amount of their net income, which is the implicit argument in the buyback. The people want to ban buybacks, that every company should be reinvesting more. Dividend policy has to be idiosyncratic. Even as you look across this class and you look at the different companies here, I would say a third of your companies should be returning more than they do because they really should not be reinvesting. And a third of your company should not be paying any dividends at all. And mandating one payout makes no sense across companies because each company will be different on free. Any questions on dividend mandates? Move on to third case. Okay. I used to do a training program for BP, and it was a very strange. They brought in their 15 brightest engineers. These are who worked in their oil fields into a room in London. They say, "Can you teach them all the corporate finance they need to know to go from being engineers to managers?" It's actually the easiest class I ever taught because the math was like a no-brainer for them. This was so easy for them. But I picked BP because of the company they could relate to. So basically, they come in, and I take them through investment. So basically, like Disney, I would take BP all the way through. I get to the dividend section. And when I worked through the numbers initially, I thought I had made a mistake. And you're going to see very quickly why. The free cash flow equity I came up with was about $571 million a year between 1983 and 1992 on average. So let me pause right there. You have 571 million free cash flow equity. You should be able to return 571 million. They were returning on average about $1.5 billion in free cash flow equity every year. 1 billion more each year than they could afford to. Clearly, they were paying out way more. It was all dividends, no buybacks, just dividends. BP had one of the most lucrative dividend yields of any oil company in the world. So clearly, they should cut dividends, right? But remember what I said, start at the dividend section, you get the shareholders you deserve. You pay these huge dividends, guess who you attract to your company? Not just people who like dividends, but dividend addicts. That's the best word you can use. People are addicted to dividends. So your shareholders are all dividend addicts. And what are you going to try to tell them? That you're going to give them a little less of what they're addicted to. And it's like getting a bunch of cocaine addicts into a room. Say, can I give you a little less cocaine? How about no cocaine at all? It doesn't work very well. And you could see why BP kept putting off this big. Everybody knew at BP, including the janitors, knew there was a dividend problem. You know why? The janitors couldn't get a new vacuum. Why? Every dollar in cash was going up to pay dividends. Everybody knew there was a dividend problem, but nobody seemed to want to do anything about it. You know what the classic reaction, top man? Maybe something good will happen. Which for an oil companies what? Oil prices will go up. There's a brief moment in 91 when Saddam Hussein wandered into Kuwait and oil prices jumped. You can almost see people at BP dancing on the desk. No more dividend problem. No more dividend problem. A few months later, it was back in spades. So finally, BP did the right thing. They cut dividends. You know why they cut dividends? Where do you think they came up with $1 billion every year? They went out and borrowed money. They were the most over-levered oil company in the world by 1992. So in 93, they go out to borrow money again to pay dividends. And this time the banks say, no, you're already over-levered. So they cut dividends under duress. And to show you there's no justice in the world, this is the news article that showed up the day they cut dividends. BP shares plummet after dividend is slashed. You see, but they're doing the right thing. What do you think is happening? In fact, to complete the story, the share price plummeted, but it came back fully in about 6 to 8 weeks. What do you think is happening in that 6 to 8 weeks?
Change of share.
Basically, the dividend addicts are saying, this isn't enough for me to be addicted to. They're selling their shares. A new group of shareholders is coming in, but that change is never painless. It's pretty painful. And during the process, half the management lost their jobs. This is why dividend cuts, especially if they're forced on you, are painful because they create a lot of bloodshed along the way. Top management lost job, and I think it deserved to, because if they'd done something about this in 97 or 1988 or 1989, they would have been able to spin it a little better in their favor. They might still have had pushback. But by waiting until it was thrust upon them, they had to cut dividends. They got the worst of all circumstances. Be interesting to see how many small and mid-sized banks this year cut dividends, because you can see they need to, right? You don't even need to compute the free cash flow equity. Regulatory capital should go up. They should be setting aside capital for the write-down of their assets. It'll be interesting to see how many of them get ahead of the process and how many will wait till they have no choice but to cut dividends and face what happened at BP. So when you look at dividend changes, you can see it's painful. So the question is there an easy way to cut dividends? And the answer is no. But is there a way in which you can cut dividends and not have this backlash be as bad? You can try. This actually is a study that looks at dividend cuts with different contemporaneous factors going on. So if you get a dividend cut with an earnings decline or a loss, you get a drop in the previous quarter, the quarter before the dividend cut, you get a quarter in the announcement period, and basically the quarter after there's a little bit of a recovery, but you can basically see negative, negative, positive. If you have a prior announcement of an earnings decline, you basically have a loss in the stock price down in the previous quarter again. But in the announcement period, every conceivable group gets punished. The only difference is if you can package your dividend cut with what you plan to do. So let's suppose you're a company where you're cutting dividends, not just because operations are coming apart, but because you have plans for it. You can package it and offer it as a package deal. The immediate reaction is we don't trust you, and the stock will drop. So it's almost unavoidable. But if you do it right, perhaps you will see that recovery as investors wake up and say, hey, this company is not in trouble. It's just reinvesting more, it's changing its business. That's the investor base changing. But it takes a little while for it to happen. And if you're not willing to deal with that, you'll stay with dysfunctional dividend policies, even though you know you can't afford them. So for those of you who are paying too much in dividends, one of the things you might think about is how can this company package a dividend cut if it does it today in a way that it's going to be at least palatable to shareholders and perhaps reduce the impact of that dividend cut. Because you just say, we're cutting dividends, investors will assume the worst about you, who can blame them, and push your stock price down, and you will not get any of the upside of taking that cash and putting it to good projects until it's way too late. So we've looked at 3 companies. Let me bring in a new company into the mix. A company called The Limited, which for a while was one of the fastest growing, especially retailing companies in the US. So 1980s and 90s, the Gap and The Limited were everywhere, right? Every mall, every. So this was in the period of high growth for The Limited between 83 and 92, their average free cash flow equity. So this is a young growth company with negative free cash flow equity, which is what you'd expect. But it's a company that seems to be paying a substantial amount of dividend each year. And some of you might have this phenomenon. You have a young company, it's growing, and its free cash flows equity have never been particularly positive, but they've started to pay dividends. The question is, why would they do that? Now, why do you want to dig yourself into a hole, especially when you need the cash so much and you have good projects and you're opening nice stores that make well above your cost of equity? I don't know the origins of how The Limited started paying dividends, but I'll give you one possible rationale. So there's the 1980s, middle of the 80s, 83 or 84, you're The Limited, you call me in as an investment banker for advice on, you're still new to market, you don't know what investors want, what they don't want. So what should we do as a company to push up our stock price? And I come to you with a story, it sounds pretty reasonable, which is, if you don't pay a dividend, there are investors who cannot hold your stock. Is that true? Yeah, there are some pension funds who can invest only in dividend-paying companies. Fewer now than they used to be, but it used to be very common in the 80s. But some pension funds have a constraint. If you don't pay a dividend, we don't own your stock. So here's the rest of my sales pitch. I say, look, I know you can't afford to pay dividends. Your free cash flows equity are negative. But what if you paid a token dividend, a little bit of a dividend, because now you can get on the list of those pension funds that increases demand. Your demand goes up, your stock price goes up. Sounds alluring, right? This is how companies get pulled into dividend policy. You pay a token dividend, those shareholders now buy your shares. What do they ask for in the next period? More dividends. If you cannot afford dividends, don't go looking for shareholders who like dividends, because they're going to ask you to pay more dividends, because the hole is only going to get deeper. So young growth companies, I think, need to think about, do I want to appeal to all investors? Do I want to appeal to investors who like my dividend policy? There are enough investors out there who will buy shares without dividends. Why go looking for investors who want dividends? Because eventually it's going to put you in a trap. Last example, let's look at Tata Motors. Free cash flow equity, even with debt considered, was 826,000. There are dividends and so if you look at pre-debt, it's minus. But this is a company that is paying dividends and buying back stock, but it's doing so by borrowing money. And we talked about where that debt capacity comes from. It comes from the fact that the Tata Group has debt capacity. Tata Motors is actually by itself over 11. But here again, you can see the family group dynamics of companies essentially using cash that belongs to the group effectively to pay dividends or sustain dividends that otherwise cannot afford to pay. So when you look at your company, bring all of those into the picture. So I have my companies kind of listed out here in that matrix. I have Baidu, which was paying no dividends and had a cash surplus. And I said, no pressure there. The company should not be paying dividends. You had Deutsche Bank, which had a cash deficit and poor projects. Disney, Vale, and Tata Motors to different degrees in a matrix where they had good projects, but seemed to be trapped into dividend policy, where they were paying out more than they could afford to. There's a dimension I should probably bring in. Remember, when we looked at these companies, we also made an assessment of whether they were under-levered or over-levered. Saying, why would that matter? If you have a company that's paying out more than it can afford to in dividends, but it's under-levered, you're going to cut it some slack, right? Why? Because if you pay out more, it moves you towards an optimal debt ratio. If you have a company that's paying out more than it should afford to and is over-levered, then you're really going to say there's urgency here, you need to do something about it. So bring in what you found on the leverage section as well into this assessment, because that's going to allow you to form a final judgment of the company. So your dividend policy section, start by assessing free cash flow equity. Try to do it over 3, 4, 5 years. I give you, the spreadsheet does it over 10 if you can give me, but if your company's been around 3 years, you can't do much more than 3. Look at the cash return. Make a judgment on, do you trust the managers if it's accumulating cash? And if it's paying out too much, then bring in the leverage assessment, say, does the company need to do something quickly? And remember, if you don't do something quickly, it's going to build up and eventually it'll be forced upon you, like BP was, and you don't want to be in that place where you're forced to cut dividends.
What do we do if, because we're analyzing the aggregate amounts in 10 years, but what happens if we see a trend towards it?
Then use it, right? So basically, if you see a trend where the free cash flow is turning positive over time because they're reinvesting less, you might bring that trend line in because it's all about the future, right? There's nothing that stops you from taking that free. In fact, in that free cash flow equity spreadsheet, I allow you to forecast future years. So there you can bring in trend lines of saying my net income is growing 10% a year, but my CapEx is growing only 4% a year, which means your future free cash flows equity are going to be positive. And you might say, right now, my company is paying no dividends, but it's got to stand ready because its capacity to pay dividends or return cash is going to open up over time. So start with the past, but it's always about the future. So there are trend lines, bring them into your forecast and make your best judgment on your company. So if you're doing a bank, and most of you are not, luckily, one of the trend lines might be regulatory capital ratios are going up, which means your future free cash flows equity are going to turn negative. You need to get ahead of this game and cut dividends now when people know there's a banking problem rather than wait a year or two and let it catch up with you. Odds are the bank will not listen to you. They'll continue to pay dividends, hoping the problem goes away. I mean, denial runs deep in management when it comes to dividend policy. But all you can do is say, look, this is what makes sense. Incidentally, on your overall project, that's what I'm looking for. I'm not looking for a collection of numbers. I'm looking for a narrative. about what the company does well, what it does badly, and what you think the company should change. That's what all the numbers feed into, is that assessment of the company and what you think it can change going forward. Any questions on free cash flow, equity, and dividends? Now, I wish I could tell you that most companies look at their free cash flow, equity and decide how much to pay in dividends, but you're going to very quickly realize when you look at your company that that's not the case. That what drives dividend policy is what everybody else in the sector is doing. So remember how we looked at capital structure? Me tooism drives how much companies borrow. Same thing seems to apply with dividend policy. And this table, I've essentially compared the dividend yield and payout, those two metrics I had for the companies, to the groups they're in. So if you take Disney, it pays, its dividend yield is about 1.2%. Its payout is about 17% if you look at the average. That's pretty close to where the entertainment sector is. So Disney looks like it's very close to where the entertainment sector is and how much it pays in dividends. If you look at automobile companies, Tata Motors, you look at Tata Motors dividend yield and payout ratio again, pretty close to the it pays out a little less than the typical auto company, but not by that much. In fact, every one of these companies, when you look at the sector, you can see how much of what companies do comes from looking at the sector. So that bank that you want to cut dividends, when you go and tell them cut dividends, you know, the first reaction is, will we not look strange? Will we not be the outliers if we're the only mid-sized bank that doesn't pay a dividend, everybody else does? And you got to have a story package of how you sell this to investors. I think right now that story is sellable. Investors are looking for banks that are actually being realistic, but it's going to be a tough sell because CEOs and CFOs hate to be separated from the pack when it comes to debt policy and dividend policy. And who can blame them? Because what do equity research analysts punish companies for? You look different. You're paying out too much, too little. And they do it in very simple comparisons to the sector. So it's almost like you have an ecosystem pushing you towards Me Tooism. And you have common sense saying we need to be in the other direction, but it takes courage to actually break away. Now, I took a look at Disney's peer group, and you can see that the peer group is not really like Disney. It's much smaller entertainment companies. Many are riskier entertainment companies. Many pay no dividends. So when you look at companies relative to the peer group and you go past the averages, you very quickly realize the diversity of companies. So you know what we did with debt policy when we did peer group analysis, and rather than compare the average, look at what causes payout ratios and yields to be different across the sector. I ran a regression for in the case of debt ratios across the sector. You can try that on dividends. Keep it very simple, right? If you have different growth companies with very different growth rates in your sector, common sense dictates that higher growth companies should have lower payout ratios. And if your company has much higher growth in the sector, it can justify why its payout ratio will be much lower than the peer group. Now, if you're interested, I have a market-wide regression of dividend payout ratios and yields. Truth in advertising requires me to tell you that the R-squareds are awful on dividend policy, just like in debt, trying to explain differences across markets. But if you want a very quick cut of what does my company look like relative to the typical company in the market, I have the regressions for the US and for global companies of yield and payout ratio. You can plug in your company's numbers in and see what its yield and payout ratio should be given how everybody else is setting. It's not my preference. I'd much rather you focus on your free cash flow equity and set your dividends. But if you're caught up and we want to be like everybody else in dividend policy, this gives you kind of a generic way of doing it. In fact, my regression for payout and yield, high beta companies, I hypothesize should have lower payout ratios. Riskier companies should pay less in dividends. High growth companies should pay less in dividends. And how much you have as debt essentially allows you to pay more dividends. Companies with more debt essentially pay more dividends. Now you can throw in your own proxies and then see if you can explain differences in yield or payout. But increasingly, because of the buyback phenomenon, you might have to bring in buybacks into the picture. Otherwise, you get a very strange sense of what your companies are actually returning to their shareholders. Okay. So in the case, I plugged in Disney's beta growth rate and its market debt to cap ratio. I came up with a predicted payout ratio of 27% and a predicted yield of 1.4%, which means that they're paying out pretty much what they should. in terms relative to other relative to other companies in the market. Any questions about dividend policy in general? Now, through all of this class, we've said the objective in corporate finance is to maximize the value of this business. And we've curiously sidestepped the question of, hey, where does value come from? We've never actually fully confronted value. Even in the context of capital structure, we talked about change in value, but we've never talked about value and how all of these decisions feed into value. So as a tail end of this class, what I'd like to do is talk about valuation, not so much as a standalone device, but as a way of connecting everything we've done in corporate finance to that number. So let's start with a very simple distinction. Those of you in my valuation class, you've heard me talk about this before, so I'll do it. I mean, but if you're not, it's a good introduction to it. When you're asked to put a number on a company or an asset, there are only three ways to put that number, only three. There are hundreds of different models, only three ways you can put a number on an asset. The first is to do an intrinsic valuation, where you put a value on an asset or a business based on its fundamentals, its cash flows, its growth, its risk, valued as a business. That's what a discounted cash flow valuation tries to do if it's done right, is to bring in cash flows, growth, and risk into a number. The second way you can put a number on something is to look at what other people are paying for similar things. It's called pricing. Okay. 90% of what passes for valuation out there is actually pricing. Bankers don't value companies, they price. Portfolio managers don't value companies, they price them. That doesn't make it bad, it's just different. Because in pricing, what are you saying? Fundamentally, you're saying, on average, the market is right. My job is to find mispriced assets in a market by looking at what the pricing looks like across the sector. Very different philosophical question, though. What is the price of a company as opposed to the value of a company? There's very little in valuation that I think of as new and different, but in the last 30, 40 years, you've seen people take option pricing that was designed to value options and apply it in the context of actually valuing companies. It's called real options. It's useful in a subset of companies, maybe 5% of companies. We could argue bringing in an options argument is sensible. I'm not going to do much pricing or real options in this class because it does require deeper digging in of the basics. I'm going to focus on intrinsic value and how it's tied to all of the things we've talked about in this class companies need to do in terms of picking projects and financing them and paying in dividends. So let's start with a very simple proposition. The value of a risky asset is a present value of its expected cash flows. That's at the heart of intrinsic valuation, that equation. In the numerator, you've got your expected cash flows. In your denominator, you've got the risk-adjusted discount rate. That's what every discounted cash flow model is, right? And if you break that model down, the value of a company is determined by three things. The first, its capacity to generate cash flows from existing investments. Second, its capacity to grow these cash flows in the future with the reinvestment needed for the growth. And third is the risk in these cash flows. Every discounted cash flow model, those are the three drivers: cash flows, growth, and risk. A discounted cash flow model is just a vehicle for bringing those in. So at this stage, let's take a look at valuing entire companies, because you're now valuing a portfolio of assets, a collection of projects. There are two ways you can approach valuation. The first is you can value the entire business. Think of that as valuing the left-hand side of the balance sheet, essentially the asset side, the operating business. As opposed to what? As opposed to valuing just the equity in that business. It's a choice you got to make very early in valuation. Do I want to value the entire business or do I value just the equity? Because every single input in valuation is going to be driven by that choice. I'm going to take my 4 companies. I'm going to do equity valuations on a couple and give you the rationale for why I took that branch with those 2. And I'm going to do a firm valuation of the others, and I'll give you a rationale for why. But this choice has to be made right at the start of the process. So you're saying, well, what's the difference? If you're valuing equity in a business, everything is equity focused. Your cash flows are cash flows to equity investors. And by now you have a very good sense of what that is, right? I mean, if you're lazy, what's your cash flow to equity? You're an equity investor in a publicly traded company and you're in a hurry. Use dividends or dividends and buybacks. You look at the actual cash return. But after the dividend section, we have an alternative, right? Even if a company is not paying dividends, you can estimate free cash flows to equity. So they're both cash flows to equity. One is looking at what companies actually do. The other looks at what companies could be doing. Cash flows to equity. After debt, after taxes, after reinvestment. If those are the cash flows you're discounting, the discount rate you should use should be the cost of equity. Cash flows to equity discounted at the cost of equity is the value of equity. The dividend discount model is the oldest discounted cash flow model in use. I think it was first mentioned in the 1938 book by John Williams. It's been around almost 90 years. Take dividends, discount them back at the cost of equity, you get a value of equity in the company. But a more general approach is to take free cash flows equity, discount them at the cost of equity, you come up with the value of equity. That's equity valuation. What's the difference in valuing the entire business? Now you're looking at the fact that a business gets its capital from both equity investors and lenders. So let's play a game. You guys are equity investors. You guys are lenders of the firm. I get capital from you by issuing shares. I get capital from you by borrowing money. I take the capital, I put it in play in operations. I get cash flows from the operations. Who gets first claim? You do, and you get interest and principal payments. You get whatever's left over if I have free cash flow to equity. The collective cash flow that you both make, and it's very counterintuitive now, because I'm asking you to think of the banker as your partner. The collective cash flow you make is the cash flow to the firm. Free cash flow to the firm is the collective cash flow that equity investors and lenders make from the firm. It's a pre-debt cash flow because lenders are no longer outsiders. They're brought into the business. It's still after taxes because the government is not your partner as far as I know. Yeah. So basically, it's an after-tax, after reinvestment, but before debt payment cash flow. And if that's the cash flow I'm discounting, I can no longer just use the cost of equity, right? I've got to use a weighted average of the cost of equity and the cost of debt, which at this point in our corporate finance class should be almost common language, which is a cost of capital. Cash flows the business discounted back at the cost of capital. Gives me what? The value of the operating asset of the company, whatever's in those cash flows. There's some cleaning up to do. We'll talk about after you get that present value. But this is a choice you got to make right at the start of the process because every single input into your valuation is going to be driven by these choices. So when I think about a discounted cash flow model, I think of it as a vehicle for me to bring in these inputs into value. So there's the equation. Value of an asset is the present value of the expected cash flows discounted back at a risk-adjusted rate. Cash flows from existing assets come from my base year. So when I'm looking at the current financial year, I'm looking at the earnings and the cash flows. Those are my cash flows from existing assets. So that enters the discounted cash flow model as my base year numbers. The value of growth shows up in two places. One is the good place, which is when you have growth, what happens? Your revenues and earnings grow at a higher rate. So I show it as the good side. You're saying, what's the bad side? To get that growth, I need to reinvest. So what I show as reinvestment, net capex, acquisitions, R&D, is what I'm putting into the company to get the growth rate. Now you can see why growth can add value, do nothing for value, or destroy value. You're saying, how can it destroy value? If what you're getting on the good side by increasing earnings and revenues is more than offset by what you're reinvesting back, you're actually destroying value as you grow. So the value of growth in some companies can be negative if it is in fact investing far more than it's getting back as a plus on growth. So value of growth shows up in your growth rate and your reinvestment. So your existing assets, the cash flow of existing assets get you started. The value of growth shows up in your growth rate and your reinvestment. The only place in a discounted cash flow model for risk is the discount rate. I know it makes people uncomfortable. They want to bring in risk everywhere. I want to adjust my cash flows for risk. You can't do that because if you do that, you'll end up double counting risk. So the risk discount rate becomes the vehicle for all of your risk. Now you can see if your equity focus is just going to be cost of equity, the entire business is going to be cost of capital, but they're both risk-adjusted discount rates. And there's one final loose end that I think should be dealt with. Otherwise, your valuation is not complete. The value of an asset is the present value of the expected cash flows on that asset over its lifetime. So if I give you a 10-year asset, you produce cash flows in the next 10 years, you discount the back, you're done, right? The end of 10 years, you salvage, you get whatever, you put it on eBay, you might get nothing, you might get a salvage value of 0. But when you value a publicly traded company, you face a problem. And the problem is that if you look at a corporate charter in the US and much of the world, the corporate charter gives you a date on which the company was founded, but it doesn't give you a date on which it's wound up. I'm told in Argentina it's different, but maybe there's a reason in Argentina it's different, because everything is finite in Argentina. Nobody wants to think forever, right? But maybe that's what we should bring in everywhere. So you have a starting point, you have no ending point. And this creates a mechanical problem for us. You see why? A company, at least in theory, can last forever. You cannot estimate cash flows forever. Yesterday, I was working with an Excel spreadsheet on my flight back from California, and I ran into the very last column. You know how eerie it is when you get to the last column and you just fall off? There's nothing left after that. It's a really, really big spreadsheet. You cannot project cash flows forever. You'll run out of columns. And never mind patience, you got to estimate cash flows in year 1, year 2, year 2053. So in valuation, we've constantly wrestled with what do we do when we get to that point where we want to shut the cash flows off. You can't ignore cash flows beyond that. But remember what we did with the Disney theme park? You got to year 10, we waved our hands and the project can go on forever. We brought in the cash flows beyond year 10 with a terminal value. That terminal value reflects present value of cash flows beyond that point in time. Now, I know there are multiple ways in which people compute terminal value. Most of them are incompatible with an intrinsic valuation. But how do bankers get terminal values? You ever worked at a bank, you get to year 10. How do most banking valuations get that big end number? They use a multiple, EBITDA multiple, revenue multiple. That's a pricing. You made your discounted cash flow valuation into a forward pricing. You can't mix those two together. There are only two ways to get a terminal value in an intrinsic valuation. One is to do a liquidation valuation. With a private company, you might say, look, I'm not going to assume forever. The owner dies, the company is dead with it. Liquidation valuation, you shut the company down, you sell it, the pieces off for whatever you can get. The second is a going concern value. What does a going concern value require you to do? You got to assume, you get to year 10, you say my cash flows will continue for how long? Doesn't have to be. We've gotten trapped into assuming it has to be forever because it gives us a convenient present value equation. It can be for another 40 years, another 80 years. We don't use that choice enough. And I'm going to argue we need to do that more, use that choice of having a finite growth period, because the companies of the 21st century are much shorter life cycle companies, the companies of the 20th century. The reason we fell into this perpetuity assumption is the companies of the 20th century, the ones that survived, tended to last 100 years, 120 years. And it turns out that the present value gets to be very close to a perpetual present value once you get past like 60 or 70 years. But it's true, a lot of discounted cash flow valuations, you get to year 10 and you assume a growth rate forever.
Yeah. After the year 6, the saving or even calculate the present value of that cash flow is.
That's why I'm saying once it gets to a really long life, in fact, that's always been the justification for a perpetual growth rate. None of us is unrealistic enough to believe that things last forever, I think. But if things last for a really long time, you might as well use the perpetuity assumption because it's convenient, gives you roughly the same number. But how long did Yahoo live as a company? Founded in 1992. Had a $100 billion market cap by 1999. Peaked in 2004. What happened in 2004? Google went public. And then by 2015 was done as a company. 23 years from start to finish. I think it's more typical of the 21st century company. No matter what you think of Zoom, do you think Zoom will last forever? I don't think so. The technology will change, the platform will change. The companies of the 21st century, we're looking at 25, 30 years, and here the forever is going to get us into trouble. Because we're now not talking about 60, 70 years, we're talking about 25 years. And there, why not use a 15-year growing annuity when you get to year 10 to bring in years 10 through 25 and say, hey, by the time we get to end of year 25, the technology is going to be done, my terminal value should reflect. Where, when people critique discounted cash flow valuation, they're critiquing a very rigid version of it, which is you always do the same thing with every company. You always assume that you get to year 10, every company lasts forever. When I valued Aramco, and I did this in my valuation class, I got to year 10 and I said, you know what? I'm going to give it only 40 more years. I gave it 50 years as a life. You know how I came up with the 50 years? Well, what does Aramco have as a company? What is it's got 300 million barrels of oil under the sand. So basically, I looked at how many years it would take to get those barrels of oil out of the sand. And when I was done, there is no terminal value. What are you going to pay for Arabian oil sands after the oil's been taken out? So in a sense, be willing to be flexible, but you're right. At the end of year 10, you got to make a judgment. That's what a terminal value does. It brings in what happens after year 10. Everything you know about a business is somewhere in a discounted cash flow model. And my problem with discounted cash flow models is they've now become almost entirely Excel spreadsheet models. People have lost the connection between what I'm using in the model and what I'm assuming about the company and where it gets its value. So,
mature company, we can use a short.
But remember, even there, mature company, the forever still applies. It's when you use the terminal value that changes between a growing company and a mature company. If you have a company that's already mature, you can just use the terminal value equation right now. It's just a present value equation, right? There's nothing magical about it. So if you gave me Toyota or Procter & Gamble, and I said, you know what, the company is already mature, I'm going to use that mature company's numbers today and use it in one terminal value equation, you get the same value as putting in 10 years of growth at 2%, then putting a terminal value with a 2% growth rate.
But my question is, shouldn't you use a fixed amount of years for the terminal value?
Why? Mature companies can last forever. Right. The standard assumption we made historically is that mature companies last for a really long time.
So not mature, but declining business.
Declining business, it's different. Declining businesses, not only can you reduce the number of years, but what else can you do for your growth rate in perpetuity? You can use a negative growth rate. You're not required to use a positive growth rate forever. You can put in a -3. So if I'm having a tobacco company, I'm not going to put in a 3% growth rate forever because there is no 3% growth. You can put in a -3% growth. And what that'll do is it'll allow your company to peak in year 10 and then gradually over time decline and go away. Same thing maybe with fossil fuel companies. Maybe fossil fuel companies, we shouldn't be using a 3% growth forever. We should be bringing in a negative growth rate beyond year 10. So a lot more flexibility in the DCF than we believe there is. But I think it's, but I want to make a broader point, which is, and it's a point that I've been struggling with because, I've been teaching valuation for 40 years and I've seen how valuation has gone from valuing companies to Excel spreadsheets. It's become financial modeling. We have hundreds of line items, and you've seen banking valuations. They go in hundreds of line items, and you look at the line items. You have no idea what's going on because there are so many line items. So one of the reasons I emphasize, and this is a big part of the valuation class, is every valuation you're telling a story is to force people to think about the numbers that go into that Excel spreadsheet. So I'm going to start with a question, and this is a question I'll come back and ask you if you do come back to my valuation class. If you think of what comes more easily to you, are you more naturally a story person or a number person? Think about what you like to do as a person. Do you like to work with numbers? Do you like to tell stories? You say, how would I know? You've known for a really long time. Starts around 9 or 10. Do you like your algebra class, your literature class? You already self-select, and you self-select whether you go for a numbers degree or a story degree. A numbers degree would be engineering, math, science, maybe accounting, or story degree would be literature, history. And then you get a numbers job and a story job. And the problem is we live in a world of tribes, right? Numbers people end up working with other numbers people. Story people end up working with other story people. And it's very dangerous because each group has its own delusions. What do numbers people believe? They believe that numbers are precise. right? You add more decimals, you got a more precise number. And if you got a numbers background, that's been built into your psyche. Precision is the key. Get more decimals going. They believe that if you use numbers, you cannot be biased. The storytellers are so biased. If you work with numbers long enough, you know how to bias with numbers, right? You know which numbers to pick to make your value higher, which numbers to avoid to make your number. But you at least operate in this perception. I'm a numbers person. I'm being unbiased. It's all numbers. And third, you think just because you have a number on something, you're in control of it. And this is the illusion that banks operate under when they compute that value at risk. It looks okay. We're okay. Measuring something doesn't take care of a problem, but we seem to think that it does. So if you hang out with numbers people, though, these are not illusions. You act like this is the way the world works. And you work with numbers and your delusions get baked into your numbers. If you're a story person, you have a different set of delusions. The first is you don't think, if you're creative, you can't put a number on that. I remember when Disney was producing The Lion King, the Broadway show, and they made the mistake of handing over the reins to the person who was the creative director of The Lion King. And her view was, how dare you put a budget constraint on me? I should be allowed to be as creative as I want. And that kind of captures the mindset. If I'm creative, don't get in my way. Don't kind of constrain me. The second is if I tell a really big story, I should get a really big value. I see that with some founders. I told you a big story. Give me a big number. And the third is that it's happened before. If I give you anecdotal evidence, they're big on anecdotal evidence. I give the example of my mother-in-law, who is not the most rational person in the world. But she comes up with this most outrageous statements, and you sit there saying, what? I remember, about 20 years ago, sitting at around Christmas time, she says, the best car to drive in a snowstorm is a Volkswagen Bug. And you say, what? You know how much a Volkswagen Bug weighs? Is like 300 pounds with a motorcycle engine in a snowstorm. Doesn't sound. And you say, how do you come up with this? You should never ask her the question because she always tells you. She said, but 30 years ago, I was in Lake Tahoe. It was snowing and I was driving my Volkswagen Bug in the middle of a snowstorm. And I got home safe and 2 other cars went off the road. You wait for the big. So that proves it, right? Volkswagen Bug is the best car to drive in. And you get this sometimes with storytellers. They give you the story of something that a company has done. Say, I'm doing exactly the same thing. Therefore, I deserve a high value. I have the advantage of talking to founders and VCs sometimes about valuation and to bankers sometimes about valuation. It's like talking to very different groups. Bankers, numbers based. Where does it show up in the spreadsheet? Founders and VCs, all story all the time. No, don't bother us with numbers. But you can see how their weaknesses get built into what they do. So about 7 years ago, I decided that valuations were becoming less good over time because even as we were getting more data and more powerful, because we turned it over to spreadsheets. So that's why I wrote a book, and still a book I most enjoyed writing, called Narrative and Numbers, about connecting stories to numbers. I said those numbers in your spreadsheet have to tell a story. In fact, I'll give you a challenge. You give me an Excel spreadsheet with a valuation of a company. I'll tell you the story you're telling about the company back to you. You might not like that story, but it's your story. I'll give you an example. You give me a spreadsheet of your company and its revenue growth is 30% a year for the next 10 years. You're telling a story about growth, right? Its margins are going from negative to well above industry averages. And you're doing this with very little reinvestment. You're telling me a story about your company? Yeah, here's the story I see. A high growth company with immense competitive advantages or very weak competition in a business with almost no capital intensity. Maybe your company fits that story or not, but by thinking about the story that drives your numbers, you essentially get a chance to revisit the numbers you're using rather than just take past numbers and extrapolate them. The spreadsheet I'm going to send you to value a company. I know it's the tail end of the class. I don't expect you to kind of do in-depth valuation, but you know enough about your company now after spending 14 weeks with your company on capital structure and dividend policy and investment policy to essentially make those broad inputs you need that spreadsheet has a story sheet where I ask you to take every input. So basically, there are only three inputs I ask of you. What's your revenue growth? What's your operating margin going to look like in steady state? And how much will you have to reinvest? And with each input, I ask you, what's your story for this company that justifies that input? What is it you're telling me about your company? It forces you to think about the links between the stories you tell about companies and the numbers. And in my view, that is what makes for a good valuation. It's a bridge between stories and numbers. Every number in your valuation, when I point to that number, say, why is that number what it is? Has to have a story behind it. Yeah. So if you're valuing Tesla and you know, what is ARC's revenues? I think ARC is, of course, Cathy Wood's company. They put out a valuation, if you can call it that, Tesla. But in 2026, I think they had $2 trillion in revenues. When you see 2 trillion revenues, first thing is shock factor. What's the largest revenue company in the world right now? I think it's Walmart. Now, Apple has higher profits because it's, you know, Walmart is 600 billion in revenues. So that's the largest. What's the largest automobile company? I think Volkswagen, 350 billion in revenues. You're projecting 2 trillion revenues. I'm going to say, let's stop here. Tell me how you get there. It can't be cars, right? Because cars alone, you get to 2 trillion, you're not just at 50% of the market, you're bigger than any car company in history. And think of the assembly lines you will need to turn out, you know, 20 million cars a year. What else is in there? And maybe you have a good story. What's the story that ARC is telling for the difference?
That they're going to do new business. Yeah, not only cars.
But they're naming one particular business that they see the biggest promise in. Automated driving, right? Basically that you can get Tesla cars automated driving, and the implicit story is this can replace Uber and Lyft because you can now send these cars out to pick people up. And okay. You know, collective revenues of Uber, Lyft, and every other ride-sharing company in the world is 200 billion. So you're getting from 600. So let's say you get Walmart type revenues, plus you get 100% of the ride-sharing market. I'm still at 800 billion. Where's the extra 1.2 billion? Oh, robots. Okay. Let's try that. What was the total market I gave you for robots? I think it's like 300 billion right now. No, 200. So you add that, you're still at 1.1 trillion. So where's the extra 900 billion? Software. What's the largest software company in the world right now? It's Microsoft, 220 billion in revenue. So you take all of Microsoft's revenues added, and you're still at 1.3 billion. You can see why when you start to question numbers, you can start. So questioning numbers with data basically means you can get a sense of when the numbers are essentially losing track with reality. 2 trillion is fiction. It's a fairy tale. If you told me 600 billion revenues, we can debate it. Maybe they can get to 600, maybe 800 billion revenues, but you can't just say 2 trillion and say, oh, AI is going to take care of the difference. That's the advantage of buzzwords, right? AI will take care of the difference. Automated driving will take care of the difference. Robots will take care of the difference. No, they cannot, because you got to get to 2 trillion. ARC combines that with a 60% EBITDA. You know what kinds of companies have 60% EBITDA? Usually companies which cost almost nothing to produce the extra unit. Maybe software companies at the margin. How does Tesla get to 60% EBITDA? Will you stop making cars and make only software? What will the software run on then? The advantage of forcing every number to be backed up with a story is you can very quickly start to separate the wheat from the chaff. You can start to have real debates about companies which actually are meaningful rather than talking about your growth rate versus my growth rate. We can talk about your story for a company versus my story for a company, and it's a much healthier discussion. I believe Tesla is more than an automobile company. I'm willing to concede that. I believe that Tesla at some point in time is going to charge for software. Why? Because a Tesla without software is just a hunk of steel, right? I mean, if the software runs out, none of the stuff seems to work. So, and at some point they decide to charge you $5,000 as a recurring fee for having a Tesla, you might be willing to pay it. But all of this is built on the presumption that Tesla has such a competitive advantage over every other electric car company that they can impose these requirements on you. But I'm willing to talk about that as a story. an automobile company with a technological or a software component that allows them to earn higher margins with a significant competitive advantage over every other company. But that's a story then that you can test. Is that story okay? Is it reasonable? Because one of the things that's happened in the last few months is Tesla's been cutting prices for their cars, which tells you that whether they tell you it this or not, they're feeling the comparative pressures in some parts of the world. That kind of makes you question whether that story of Tesla as the ruler of the hill is actually a story you can continue to tell. So connecting stories to numbers is a key part of valuation. So on Wednesday, when we come back, I'm going to take my 5 companies, take them through the process. And I'm going to open up the Ginzu spreadsheet that I've sent to you already, but I'll send again, and take you through how that spreadsheet connects value. Because I want you to take ownership of your own inputs and the value that comes out. See you on Wednesday.
What is the target price of Tesla for KUs?
What's the target price for Tesla from our? I think they're estimating that it would be a $2 trillion company. No, it's $6 trillion. It's a market cap.
That market value, it should be like, I don't know. Sorry, with that level of revenues, it should be like.
Yeah, but 6 trillion was their estimated market value. It'll be 3 times more valuable than this.
Quick question. For the free cash flow, what the taking about the issue or the debt service?
That is showing new cash inflow. That's a.
The example you showed in the free cash flow probability was $1 billion dividends.
I use that illustration. So basically, if you broaden it, that's basically making free cash flow equity.
Oh, okay. But if you use the actual
then you would get free cash flow equity.
Thank you.
Actually, very normal data is for everyone. Forward the trailing numbers will always be for everyone. You look at some of the numbers.
Yeah. You did that, right?
You can only need one annual report in the most recent report they report on environment is allowed. The most recent report they report on geological enough. So let's say it's the second quarter. Yeah. Because you just said May 2020. So there should be a quarterly report on the values. That was first in the order 2023, and first report. You'll have those 2 numbers related to the annual numbers. Take out the first report 2021 as the first report. So it's almost just make a spreadsheet with every line item.
Yeah, those are the guys. But everybody, like apparently everybody.
Basically, that portion of the interest is for infrastructure. Instead of thinking of what portion of this industry.
Have you done the?
Net it out into go to footnote, maybe they'll give you
That's the net interest. Which should be in the. The dividends.
Not the dividends, the percentage change. Because of GDP and all those. It's not. Thank you.
Hi, I had a few questions about the project. First one is my company is negative because of private equity. So I know you so you can't but even ROIC is
It's really weird. Like I looked at it like
Still your choice of whether.
like also not like a
you know, there's nothing I
so like I tried it and I did ROE based off of like just the positive then but it also feels like to just ignore their purchases.
Current rating is A, they have an interest coverage ratio. So that's synthetic rating. So when it does the calculation to get the optimal,
Let's say
it adds interest. The rating gets better.
stock, right? And so they get money back.
And plus the
They
capital
took that
decreases
money from
pre-tax
earnings.
debt.
Yeah, so they know they right, but they
really I'm increasing the debt.
oh I see what you're saying.
Well,
I see what you're saying.
well,
no, but they purchased
rating
cash.
you have in this.
Right, so
But where did the too cash high, come from? right? It came from like earnings, right? From like retained earnings. So by input, it didn't come
synthetic
from
rating,
like synthetic rating, the difference.
Because
by
the
capital
individual
and-
transaction though, you're right, but the individual transactions, the cash goes
Even when I
down.
do that,
and
it
it
gives
goes
me a
down.
cost of capital which is actually high.
Like you're right, that the
Like,
cash
on that
accumulated because of
Equity,
earnings. Yeah.
yes, but I didn't
Quick
think,
question related to my exam.
like taking capital, I thought
I
it
made
was
a
a retained
very
earnings.
stupid mistake. I know that's at 1 point. Right?
Okay, this
Yeah,
is
but the
a-
transaction
then I-
is you're
I thought you
trading,
mentioned- yeah,
reducing cash, increasing stock, and then
Thanks.
basically
Okay.
stock.
Yeah.
Hey, so I have a question for when I was doing return on equity.
Yeah.
I just took a picture of the questions I had. I was doing return on equity. I never go with the book value.
Mhm.
I have I have a negative book value.
Non-meaningful.
Okay, so just ignore ROE
ROE.
and just do the ROIC as my, okay. And then I forget where, I think it was in the capital structure sheet, there was a note about like unusual, like non-operating income. At McDonald's, and they sold their, almost 1,000 restaurants in Russia. So they have like, usually that number is negative 90-ish for them, and now it's like a positive 700. Is there any way I should factor that in, like
One time.
Yeah, that's what it says.
When you do your analysis, you might say that caused my free cash flow equity or whatever you're
So-
getting to be different that year.
should I like reduce the free cash flow equity or leave it as is or reduce it
Take
to
it out.
the average
Just say
number?
that's not a normal number. It's because you want to keep free cash to equity, especially you're projecting things out.
Yeah.
You want to take it out.
All right, that makes sense. And then for the risk-free rate, because the previous data I had from the DVS only showed everything in dollars. I went back and looked at it and saw currency breakdown. So for calculating the risk-free rate, can I just use the breakdown of their debt by currency for those regions?
Risk-free rate, there's only one risk-free rate. You can't do a weighted average.
But I'm saying like, so if they have, let's say, it's like 60% US debt, 30% pound, and then
You don't do different currencies. Risk-free rate is you pick a currency, your analysis, everything's done in that currency, even if they borrowed another currency.
okay, I guess because but then wouldn't that increase their borrowing costs by borrowing in other currencies, presumably that they're higher than the American?
Inflation difference, you do that, then your cash flows.
Your cash, okay. All right, so then it's just baked into the ERP then. Yeah. Okay. And then one last question was for the capital structure as well. I noticed like the synthetic rating it got for its existing capital structure was much higher than